pretty picture there. Let's get right to the floor show. And trader John Corpina of Meridian Partners joining us live from the New York Stock Exchange floor. John, can you dissect trader sentiment right now? Because really just 4 of the 11 S&P sectors are in the red.
Liz, thanks for having me on. Yeah, the sentiment isn't as gloomy as you would think it is at this point right now. We have to take a step back, look where we were, look where we are now, right? Market performance over the last quarter, over the last 6 months, has been double-digit returns. We've been waiting for some sort of catalyst to cause investors to take some profits off the table. I don't know if we're really seeing the catalyst, but we've got a couple of things that are adding on to us here. We've got our uncertainty and our geopolitical risks and issues that are out there. Straits open, straits closed, wars on, wars off. We're going to keep playing around with that thing. We do have profit taking that's coming off, just investor sentiment, meaning let's just take some money off the table. And then the third aspect is coming into this year, we were all talking about 2 rate cuts. We're now talking about 2 rate hikes in 2026. That's adding uncertainty that's here. So yes, we're seeing pressure on the market. It's not a panic sell in the U.S. here, but we are seeing the markets drift lower, and just based off of headline news. I think at some point here we are going to bottom out. Things will turn around. We're going to get a lot of economic data this week. We're going to get some inflationary data, some spending data, some housing numbers, some more job numbers. All this together, I think, is going to show us that our economy is strong. So overall, healthy that this is washing itself out now.
Yeah, I think you're right, but it's questionable as to how long certain washouts stand. In this hour yesterday, hyperscalers were mostly higher. They are sort of mixed at the moment, but yesterday in this hour, we saw a pronounced sell-off in the same names. We're talking about Meta and Google, Alphabet and Microsoft, and it was just not a pretty picture as investors really began questioning this profligate spending on the AI build-out. And so now suddenly they're not getting hammered as hard, but it's the semis that look so bad. And all you have to do is look at the 2-day picture of some of these semiconductor names. And I'm talking about everyone from, I mean, heck, you could look at Intel. Intel looked great yesterday.
Yeah, in the last hour of trading, and that was a great point that you just brought up, the last hour of trading yesterday, we did see accelerated selling. I think some investors don't want to be long too much overnight. We're starting to see some shifting out of the tech into some of the more secure areas, the defense stocks, some of the energies, some of the higher dividends. But we normally see that over a longer period of time. It seems like that's happening overnight at this point. Again, the uncertainty of what's happening with oil and what's happening in the Middle East is going to add this pressure on our markets. And that can pivot very, very quickly. We can have a agreed upon deal signed where everyone is happy and we put that behind us. That can happen any minute at any point. Investors don't want to be caught on the wrong side of that. So I think that's why we're starting to see some sharp moves quickly.
I want to talk about leveraged ETFs. Now, it's what's interesting here is that the leveraged ETFs that are long the Kospi, so you get a multiplier effect where you don't just go long the Kospi, you go 3x long the Kospi. There's one called Koru, K-O-R-U, and those just got absolutely slaughtered overnight, and there is a little bit of a danger. Can you explain that to people, John?
Yeah, the danger that's there, the thing that I think people don't fully understand and realize is that this is based off of daily market moves, daily returns, right? Yeah. If you look at an ETF and let's say it has 8% annualized gains, and you get a double ETF, you're not playing and planning that it's going to be up 16% in a year, 2 times 8. The move that these leverage ETFs make is intraday. It's within that 1 day. So if it moves 1% in 1 day, you're going to see those returns or those losses on 2% or 3%, 2x or 3x. The moves are violent. The moves are fast. And the liquidity there isn't as much as you would hope that there would be. Sometimes it's tough to get in and out of these. So I think investors need to understand that these magnified assets, there's a lot of risk that's associated with it. You live by the sword, you die by the sword. Yes, you're going to cheer yourself when this thing is going up, but it's going to come down just as fast. We saw that overnight in the APAC markets.
Yeah, let's be clear, though. Year to date, if you held on, it's up 300%. But here, when you look at what's happening with the semis, the SOX-L, that's another leveraged ETF. That one also getting really hit hard today. But again, year to date over the long term. So what I'm hearing you say is that looking at these intraday and intra-week moves, it's really complicated to get too caught up in that.
It is, and especially when we're talking about the difference between trading and investing, right? They're two separate animals. You have to have the stomach to weather the storm during trading. When you're investing, you kind of let the market play itself out. We're going to have these dips. We're going to have these sell-offs. If you can keep some extra dry powder on the sidelines and dip back in when prices come down, all good. If you're able to do that with your portfolio. But the moves that we are seeing over the last few trading sessions are pretty unique. The VIX, as you said on your lead-in, trending below 20 at this point. We got to keep it below 20. If we start seeing it poke its head above 20, I think we're going to start to see more on the downside.
Yeah, 43 cents below 20. It's 19.56. All right. John, great to see you on a very interesting day, definitely.
Yes.
But keep in mind, folks, the S&P and the NASDAQ are on pace for their best quarter since 2020.